And we're recording. So, have a little chat today about finance and how finance relates to business. One thing I've noticed being an entrepreneur is that the job description almost never ends. And you have to learn things most often the hardest way possible. And one of the things that you kind of see entrepreneurs coming from about three different backgrounds. They're either their sales, their operations, or their finance. And the problem is most businesses don't have those three elements when they start. So it's always a struggle. So today I wanted to have a conversation in regards to finance and how it relates to businesses. When I speak from 14 years of sales. And I started my business, Grow Business Development, simply to help businesses go and get out there, bring the awareness, and help them get revenue so that nothing happens until you have the revenue in the door. And I invited you to speak today after you were just telling me 8 years of experience in financial services. I'll get you to introduce yourself quick.
Sure. So my name is Ben Wagler, and as Nick said, I work in financial services. I've been in a variety of roles, and at the moment I look at loan structuring and compliance. So I work day to day with a lot of individuals and holding companies and walk them through the process of getting loans approved and putting those loans together in the most effective way.
Perfect. Thank you. So we'll start off with our questions for the day. So what are good reasons to get a business loan? I know I get it asked all the time, and there's 1,000 different reasons why, but as you've seen before, there's a lot of reasons you shouldn't. So what would you say are good reasons to?
Absolutely. So I want to touch on something you mentioned, Nick, in your business, and what you're trying to do is really help businesses grow. And I think that is really, in my opinion, the number one reason to get a business loan. I think a lot of people in the really early stages of their business, they maybe don't have revenues set up, and they're trying to get to that point. That can often be a more challenging position to get good financing in, because you don't have any revenues to show. Whereas if you're in a position where even if your revenues are quite small, if you can prove your business concept is actually generating money, from a financial institution standpoint, that becomes a lot more attractive. You got a proven track record, and you're in a position that you want to double down on that, and you want to maybe go into other markets or increase your client base and so forth. So I think if you're looking to grow your business, that's a really good time to look at seeing if a business loan might be a good fit for you.
I find that a lot of businesses I work with, that when we talk about loans to go and grow their business, one of the biggest problems is they're doing it too premature. And I'm sure you see it, especially in those first 2 years. So
Yeah.
really, as we'll talk a little bit more about some of the aspects you have to really consider, but whether it be good credit or more like, I think the biggest aspect is just understanding how their business works. Like as I was just telling you, I'm in a process of changing my business based on feedback from my customers.
Yeah.
And me being in the first 2 years, it's a whole trial and error period. You build something, you measure to see how it works, then you learn from it. But I find that a lot of businesses, they start out really fast thinking that they can go in, and there's 1,000 reasons why businesses start, but you get these executives that want to start their own business because they think they can do it better, they think they can make new money, and they run it like a small, big entity. But that's not how it works. Unless you're going to go and pull all those clients over and then run it as business as usual, there's a lot of testing that needs to be done to see if it's valid. And I imagine you must look at that when you talk about business planning and some of the background to actually decide that with a young business if it makes sense to even provide them a loan.
Absolutely. So again, I think you touched on some really good points there in terms of preparation being really key. Of don't go to the bank or the credit union or whomever until you've gotten really comfortable with how your business works, how you want your business to work in the years to come, and getting as much kind of documented as you can to sort of substantiate where your revenues are, where you predict them to be, and have that kind of business planning together. And, it may be that once you've gone through that exercise for yourself, that you figure out, what, maybe now is not the time to go about getting a loan. And to be really honest with yourself, business loans are a phenomenal tool for the right borrower in the right circumstance. They're not a solution for everyone in every circumstance. So I think being really honest with yourself about whether that's the case for you or not is certainly helpful. And, if you go to a good financial institution, I'm sure they'll help you through that process as well. But the more thought and kind of work that you can put in ahead of time, the better.
Absolutely. With that transition, then we should probably get into what are the most common mistakes when applying for financing, because I know we touched on a couple, but I'll open it up to you, and then I'll ask a couple questions as we go.
Sure. So the first thing I want to say is that lending to a business in a lot of ways is very similar to lending to an individual. At the very core of it, the bank is going to be looking for the same things. And I don't know if you have heard of the 3 C's of credit. There's actually more than that, but that covers just the very basic parts, which is capacity, capital, and character. So capacity is your income. So in this case, it's your business income. You might put a personal guarantee in there, and that's another element. But is your business actually making positive cash flow at the end of the day? Because that's what the bank's going to look to as a source of repayment. So that's pretty important to be able to speak to that, to speak to the sustainability of that. Is this a one-off contract, or is this steady recurring revenue? Obviously, the less volatile that cash flow is, the easier your case is going to be. The second one is capital, or also collateral. So what kind of security might you propose providing to the bank? So there certainly are some instances of unsecured lending for the right borrower in the right circumstance, but oftentimes the bank will want to see some sort of security to get them comfortable that, in a worst case scenario, they have something to show for if you're not able to pay your loan. So depending on your business, that might be the receivables of your business. That might be some of your personal assets, let's say your home or some savings that you have. It might be even life insurance in some cases if there's a cash surrender value there. So understanding what kind of assets you and your business might have to offer up for collateral. And then the third piece is character. And that's a little bit harder to define. Obviously, things like your credit score, your credit bureau will come into play, but that's not the only piece. It's what's your track record. I would encourage people, if they're looking for business financing, start with the financial institution that you deal with already, because they will know you and they will have some record of, you've paid your bills on time, you've built up savings, you're doing the right kinds of things. Whereas if you go to a totally new institution, it's not that they're not interested in helping you, but they don't have that track record to fall back on. So they're going to be relying more heavily on things like your credit bureau, things like the performance that you can prove of your business. And if those things maybe aren't quite as strong as you'd like them to be, it could put you at a disadvantage.
Does it make a big difference if you're working with the same individual on an ongoing basis in the bank? So say if we were working together and I came to you personally, would it make a difference if you were going to bat for me versus just say I'm dealing with, my main branch, and I'm just dealing with, somebody in-house that they put me in an appointment with? Is there going to be a difference?
I mean, yes and no. As I'm sure, you're aware, a lot of financial institutions are going to more automated models. There are certain aspects of the lending decision that are not discretionary. They're system driven, they're numbers driven. That being said, relationships always matter. And If I've worked with you for years, am I going to push a little harder to get your loan done? Sure I am. And I think that would be true for anyone. I mean, at the end of the day, an employee of a bank or a credit union is going to have an obligation to put on good quality loans. But at the same time, if they genuinely believe in the borrower and the client, they might work a little harder or spend a little bit of extra time to really get that application in the best shape it can be. So I would say relationships, certainly in sales in your business, I manage matter. I would say that's true for financing as well.
Yeah, it doesn't matter what world you're in. It's who you know before what you know, which we both know can be quite frustrating at the same time.
Yeah, I know what you mean.
I know another problem is when we've done some of the venture capital work, one of the problems we had is getting external financing was understanding the business cycles, and if it was seasonal or cyclical, how the business actually ran. And I found that a lot of the time with more junior bankers, it could be quite difficult sometimes to explain how the cycles worked. So say, construction business is a great example. Your revenue's low in November, December, January. Well, of course it is, right? You expect that. And, even with a newer business, you have, if you can see the trends within your portfolio of how it would look. Would you recommend somebody going and making sure they seek out somebody that understands your business as well?
Absolutely. So I'd say two things. First of all, getting somebody who has an expertise in the area that you're in is very helpful, because you're not starting from square one. They've dealt with businesses, at least in your area previously, so they're probably aware of some of those seasonal trends and so forth in revenue. What we call lumpy income in my line of work, very common. Real estate is a great example. Prior to the downturn in Calgary, there's a lot of people who have made a very successful living of buying real estate, fixing it up and selling it. That's usually a multi-year process. So you have a lot of costs in the short term all the way along of purchasing the property, upgrading the property, renovating, paying wages, paying contractors. And then at the end of the sales cycle, you have a big piece of revenue that comes in. But you won't necessarily see that, within a couple of months or even within a particular calendar year. It may be 2-3 years of your sales cycle. And that's why I would encourage people, again, when they're looking for business financing, if you've gone through at least one, if not a couple sales cycles, so you can demonstrate that in your financial statements of, look, in 2013 and then again in 2016, we got this big piece of revenue and the costs were kind of spread out throughout the calendar years, but this is what our business model is. Then it allows your bank to get more comfortable with that.
Mm-hmm. Yeah, I've noticed, and in some of the business that we worked with, it wasn't even the years. When you had a business that works in a cycle, that full sales cycle from introduction to payment might be 3 months.
Sure.
Say, for you to have a couple cycles, it might be a year, but that's understanding your business, and that's a different type of loan as well, because now you're scaling. If you put X, Y, and Z in, you should get a certain amount of growth. And that's ultimately when you're in that spot, that's a great place to grow, because it takes a lot of the risk out, other than just scaling up your internal core team.
Yeah, absolutely. No, I think that's a great point.
We all like to get there, but a little bit easier said than done.
Sure, absolutely.
Trying to think of any other points right off the top of my head, but I know another one that's been really hard to get financing for, depending on how established the business is marketing.
Sure.
In your eyes, would you say that marketing is still looked at as a cost instead of a revenue generator, or how would you consider that?
I I think it can be. I mean, what you need to understand is that a lot of big financial institutions are conservative by nature. If you look at the Canadian banks, most of them have been around somewhere in the neighborhood of 200 years. And you don't last that long without having a little bit of a conservative bias. So businesses that have tangible output that a bank can understand and wrap their heads around are going to have a little bit of an easier go than businesses that don't. That being said, in a business like marketing, I think what you would want to focus on is your revenues, because your sort of receivables or equivalent thereof are less tangible. They're not, you don't have a bunch of inventory of widgets in a factory somewhere. You have a bunch of billing statements for, maybe websites, maybe consulting, maybe copy, whatever that might be, that are harder to show value for. So I think to get the bank comfortable with something like that, you're looking more at, okay, I can't maybe get you receivables that you're going to be comfortable with, but I can show you revenue, and I can show you relatively consistent revenue, over the course of a year, 2 years, and further to that, in those instances, maybe you take some personal assets potentially, or you take some business investments as possible collateral in a scenario like that to get your financial institution comfortable.
So would you say then, and I have some experience from on the other side of this with the difference between brick and mortar versus e-commerce, because I know it was a lot easier to get financing for the construction company, although it was a little bit of a battle because they were such a young company.
Sure.
The e-commerce of some of the companies that I've started to work with, it's been a real struggle. Do you have any advice for people that are in e-commerce and how to prepare themselves?
Yeah, I mean, it's definitely challenging, and part of that is it's a little bit like a lot of professional services. So you look at a lawyer or an accountant or what have you. A lot of those professionals, their value is in their brains. Their value is in the relationships they have, the expertise they have, the knowledge that they have. Their professional corporation oftentimes doesn't necessarily have a whole lot of tangible assets. And if that person dropped dead tomorrow, you probably wouldn't be able to sell that professional corporation for a whole lot, unless it's a really well-established firm, because it really is the value on the individual. And I would argue, e-commerce is a lot like that too. It's about the network that you have, the supply chain that you have, the know-how you have in the industry, the customer relationships that you've built up. And so it's hard to show those tangibly. And so unfortunately, it does kind of put you at a bit of a disadvantage. Again, all I can say to that is, focus on the cash flow where you have it. Look at potentially taking outside assets to provide some comfort there. And maybe in that kind of business, you look for business financing a little bit later in your growth cycle than, say, construction business. Maybe you wait a few more years till your revenues are stronger, till you've got more of a track record, till you've maybe invested some of your business profits into some tangible assets, and then you might have somewhat of an easier time anyway getting that financing.
Yeah, no, absolutely, that makes sense. Talking about character, and then also, your capacity, because then it's the trends, right? Long enough trend, and it shows, the numbers speak for themselves after a while.
Absolutely.
Well, we might as well flow into the last question. What financial factors have you seen contribute to businesses failing? This is I don't know where you want to start, because there's a couple places.
It's I could go on for a long time on this, but in terms of some common ones that I see, I'll just touch on a few. One of the big ones is over leverage. So debt can be a really powerful tool. And obviously, if I didn't believe that, I wouldn't be in this profession. However, it can also be abused, and we see that. We see that in bankruptcies. We see that in personal financial difficulties of people taking out more lending than they can actually afford to cover. And so I certainly see that in businesses as well, where there's not enough of a margin built into the business owner's calculations for what if things do slow down? What if you have a downturn? What if you lose a big client? Are you still able to make your loan payments? And if the answer is no, maybe your loan is bigger than it should be. So certainly, you know, we try and do some of that stress testing ourselves before we approve a loan, but we're never going to know your business as well as you do. And so you should maybe do some of that sort of, you know, figuring out your risk factors for your business. And I'm not saying, you know, be pessimistic or assume failure or what have you, but if you set your lending at a low enough level that even in your slow times you could still afford to make your payments, that's going to kind of give you the best chance at success. The second thing that I would touch on, and I see this quite often, is businesses stepping out of their area of expertise, and based on the success that they've seen in their business, they assume that they'll be successful in other areas that are totally unrelated. That's possible, but it's by no means a sure thing. And I've seen countless examples of failure there of, let's say, you know, doctors who go into land development, for instance, and I've seen more than one of those. They're phenomenal doctors. They run great practices. They have happy clients. And that's led them to believe that they can be really good at developing properties. And the fact is, those are very different businesses. And it may be that they're able to do both, but it's by no means a sure thing. And sometimes when that, you know, property development business isn't going as well as they thought, they're surprised and they're not prepared. They don't have the resources in place to capitalize it because they're expecting to be equally successful. So I'm not saying don't go out and trying new business areas, but maybe do so with a degree of caution and a little bit of humility that, you know, to some extent sticking with what you know can be a good place to start. And if you want to expand beyond that, maybe bring in some outside experts that really know the business that you're getting into. So those would be two of the core areas. I could name a whole lot more, but those are ones I see fairly regularly.
I see that a lot with M&A, where gentlemen, and I'm just talking high net worth investors, since we're on that topic, that
Sure.
Assume because they did one business right, that every business thereafter is, you know, bound to succeed. And I think they take too much. A lot of the time they put the weight on themselves, and you could call it up to whether it's their personality or whatever it may be. I've always said that success is the worst teacher because it makes you feel invincible.
Absolutely.
And they assume that they don't look at the actual core business aspects. They don't figure out, you know, the cycles. They well, you want to call it a false sense of security or just poor expectations. I would go with poor expectations because, like your doctor example, their cash flow model is significantly different than the land plays. Because, you know, it's like even when I sold insurance, it was a lot of people wondering how I did it, doing all contingent fees, commission based, because it really is nice to have, knowing that you always have a monthly income, or knowing that, you know, every 2 weeks you have money coming in because you can plan for it.
Yeah.
But how do you plan when there is no rhyme and rhythm to when you get paid? It's all about, you know, there is time, and you can build your own security blanket, but that's a burden thing as well. So business isn't quite what it used to be, but at the same time, a lot of the fundamentals still apply.
Sure. Yeah, I think the only thing I would kind of add to that is, you know, when you are looking at maybe going into a more uncertain area, whether that's starting your first business or whether that's going off in a different direction, you know, if you have a nest egg, or if you have some passive income that you can rely on, that gives you some strength. So that's one thing that we encourage a lot of our borrowers to do, is to diversify your income streams. So if one of them's not going the way that you hoped, or not getting there as quickly, you have some other streams to fall back on. So whether that's an investment portfolio that's paying dividends and interest, whether that's rental real estate where you're getting a monthly rent check, something like that, that just provides a little bit of additional stability, is not a bad way to go.
No, it sounds good. Was there anything else you wanted to add in terms of any of our questions today, or anything before we close?
I don't think so. I mean, finance is one of those things that can seem intimidating or can seem confusing if you don't have a background in it. I mean, a lot of the principles do come down to common sense, and the more preparation you can do, the more sort of working on knowing your business inside and out, the better chance that you might have for success. So yeah, it's been a real pleasure speaking with you, and hope to do it again sometime soon.
Absolutely, Ben. We'll have to go and pick another topic. I just wanted to close out with one of the things I always notice, and one of the reasons why I'm starting to do this, is people don't ask the questions that they need to ask out of fear of being, whether it's rejected or looked down upon. Just ask the question. And so I wanted to make this more conversational so that people would join the conversation. So thank you very much for joining me today, and I look forward to our next chat.
Thanks so much, Nick.
I'm just gonna